Hey, so it looks like once again the Federal Reserve is flipping. And this time you have to really look at what Nick T tweets and understand some of the history of the Fed, and then combine that with a Wall Street Journal article that Nick T just wrote. Now, Nick T, often known as the Fed Whisperer, is basically guaranteeing us that we're going to get a 25 basis point cut at this week's Federal Reserve meeting. That's on Thursday, a day later than usual because the election is Tuesday, which delays the start of their two-day meeting. So they'll have their meeting Wednesday and their press conference on Thursday. Let's just quickly understand some flip-flops we've gotten from the Fed, and then we can put this all into context. I'll do it all for you. Number one, the Federal Reserve told us that inflation would be transitory, but they neglected to tell us how long it would take for it to be transitory. Now, I do agree that inflation is going to be transitory, but it will have taken a whole lot longer than expected. It'll have taken 2022, 2023, 24, and part of 25. That's a 3.5-year process for inflation to be transitory, and nobody wants to wait basically a whole 4-year election cycle to actually get inflation down. So this is why the Federal Reserve killed their tone-deaf inflation is transitory argument, even though it's widely anticipated that inflation is going to continue to disinflate. Now, don't get me wrong, there are a lot of people that think Donald Trump will cause inflation because of more fiscal spending if Republicans sweep. Some people think Harris will cause more inflation because of inflation reduction, increases in the short term, long term down, right? So more infrastructure spending, so inflation in the short term under Harris, not good. Basically, people think if there's a sweep, either candidate is just going to spend more money, inflation is going to go up. If you have a stagnant or split Congress, House, Senate, and presidency, if these are split party, then maybe you won't end up getting as much spending. So that could be good for keeping a lid on inflation. And of course, we've got this sort of unsustainable debt path that we're on. Personally, tangent on that, I think we're way premature on the debt crisis. I think a lot of people are like, oh my gosh, the debt crisis, it's going to cause, the greatest recession ever. That might be true at some point in the future, but I don't think we're anywhere close to that. And I think we're much more likely to just kind of continue to see government spending, the debt continue to rise. And look, I don't want to sound like I'm not saying there's a problem here. There's definitely a problem. Look at our interest payments over history here. They've absolutely skyrocketed. But when you compare that to the levels of GDP, our interest outlays were a lot higher in the 80s and 90s than they are today. Now, this could obviously rise a lot, and it probably will if we keep spending like this. But this is probably still a 10-year out problem. So if we do end up with a fiscal issue that could be 10 plus years out, if we end up with disinflation, then eventually we do get transitory inflation. But the Fed did tentatively at least flip on that idea, which means there is a risk that the Fed overdoes their constraining or restrictiveness on the economy. And I think people think, oh, everything's going to be fine because the Fed's going to cut 100 basis points in 2024, 50 already and then 25. No. Interest rates sitting at 4.25% are still painfully high for the economy that we've built. I understand that may still seem low historically, but for the economy that we've built that's used to interest rates between 0 and 2%, this isn't good. You are still restricting the economy substantially, especially as we continue to see disinflation. So this isn't good. And this is a flip from the Fed that really just increases the odds of potentially causing a recession, especially with their flip on fate. They always used to say going into 2020 before COVID that they're willing to have a 2% inflation target that is flexible as long as we average 2% over the longer term, which could be 5 to 10 years. And so I've regularly believed that the Federal Reserve would come out and say, all right, inflation's at, 2.5%, about averages 2%, and they'd be more aggressive in lowering rates to prevent a recession. The problem is, last year they killed the idea of flexible average inflation targeting, and they basically told us that fate was a lie all along. F-A-I-T, pronounced fate, spelled or written out as flexible average inflation targeting. They told us it was a lie all along. Jerome Powell in a press conference, I don't remember the exact date of it, but I remember the moment very clearly because I was covering it live, and I'm like, are you kidding me? He's basically, I'm going to paraphrase here, but basically, yeah, we created this policy because inflation was running below target, but because inflation is running above target today, we don't really use that policy anymore. And I'm like, oh, so it was just a lie. It was a lie to try to make us think that you wanted inflation higher, but now you're not going to use that because you never really intended to use this average. It was a little fugazi, and it does piss me off a little. Then we have this idea of higher for longer, which we have been high for quite a while, like a year. And so maybe you could argue that they haven't flipped on higher for longer. But now it seems like they're starting to flip on this data dependency argument. And so let me show you this Wall Street Journal piece, and you can kind of see what I'm talking about here. So first of all, Nick T just wrote in the Wall Street Journal that Federal Reserve officials are expected to cut interest rates by a quarter point at their meeting on Thursday. He's almost always right with his leak here, so I think you're going to get your 25 BP cut. You won't get a 0. You're not going to get a 50. 50 would signal panic. 0 would just not be good. So I don't know that markets are going to move too much on this because it's already priced in at this point. Another thing is they acknowledge the suspense of the last one, which was the largest suspense level or wideness that we've had in 4 years, which is wild, and they don't like doing that. They don't like surprising markets. I was in 50 camp, and so I was really excited when I saw 50, but Nick T was also in 50 camp, and while there was a moment we were unpricing 50, 50 was pretty evident as we were going into the meeting. But there was still a big gap. You were only like 60% likely to get 50. And had it not been for Nick T's article on 50, I would have been a little bit more torn. But that really was the nail in the coffin. And sure enough, we got 50. So now they're saying 25 for this one. And continuing on in the Wall Street Journal piece here, they do talk about a little bit of the puzzling situation that we're in. Really what they're talking about here is like, hey, the consumer's been holding up because you've seen these stronger revisions of data. Like consider the consumer spending data that we got. Sorry, this Adobe scroll kind of sucks today. I think a setting changed. But anyway, they talked a little bit about how, hey, economic data talking about consumption has been really, really strong. In fact, we've seen consumption data revised up and savings data revised up, which is really good and removes some risks from the economy. But there are still other risks. Some of the other risks that exist are the unemployment rate rising, full-time jobs down, temporary workers down a lot. Those things both usually only happen in recessionary environments. I mean, consider that non-farm payroll was expanding on the establishment survey by 200,000 jobs per month over the first 6 months of 2024. Now we're down in the last 3 months to an average of half of that, 103,000. The trajectory of jobs is bad. And so now what they're trying to argue, here are the revisions. So you've seen revisions up in spending, but down in jobs. But the problem now is the Federal Reserve is potentially starting to flip on data dependency. Now, no guarantees of this. We'll want to pay very closely attention to this on the presser this week. But look at Nick T's latest comment. And I understand what he's saying, but I think it's a little bit of a precursor to what's to come. Watch this. An eventful week for an uneventful Fed meeting. 25 BP anticipated, so we'll get that. Officials are trying to get away from being overly data reactive. Inflation progress helps, and a puzzle looms over consumption and slowing employment. Basically, look, consumption always lags, okay? People spend money that they have because that's what people do. They're just going to blow all their money. This is why you should diversify instead of blowing your money, invest into something amazing. In my opinion, I'm biased, like House Hack. Diversify into House Hack. Go to househack.com to learn more about that. Read the PPM. But look, here's the thing. This idea about getting away from data reactiveness is basically them saying, look, we don't want to like, oh, yay, the jobs report in September was really strong. Let's go with 0 cuts. I think what they're basically trying to say is, let's get away from some of these frequent calls for data dependence, and how about we just go 25 every meeting, and let's just see how things go for the foreseeable future. I don't think they'll exactly say that, but I think that's what they're going to imply, is that they want to be like a steady moving average, and you're just going to get 25, 25, 25, 25. That's my anticipation. So basically they'll set up, you don't have a summary of economic projections this week, but they'll set up 25, they'll tee up the next 25, and they'll say, hey, look, the data's really noisy. Let's see how it goes between now and January. This is at least somewhat a departure away from the data dependence that they've always told us about. Data dependence does not mean data reactive. They're starting to redefine data dependence. This is really just another flip-flop on the flip-flops of flips. And that's because data lags. You have to remember that. And this is actually a good thing that the Federal Reserve is actually waking up to this, because you don't want them looking in the rearview mirror all the time. You want them looking forward and going, oh yeah, this labor market does continue to weaken. This was a pretty terrible October report, and even though there could be weather effects and Boeing effects, it's still a pretty bad report, and the household survey undid a lot of the good that we saw in the prior report. So, especially when you consider that the jobs that are being created right now are government jobs, which some argue are way less productive potentially, than non-government jobs, private jobs. And now private jobs are coming in negative on a month-over-month basis, which is a very recessionary warning. The Fed basically has to leave data dependence behind, and they have to start doing what they did in 2007. Remember, they cut 50 basis points in September of 2007, the same day, 17 years earlier than when they cut 50 basis points this September, which is really scary and an eerie warning. But then they started having to do panic cuts in as soon as January of 2020 or 2008, because they're like, oh, okay, yeah, the number's starting to get worse. And they realized they were behind the curve. They don't want to be behind the curve. So I think this is them starting to signal that hey, we got to get ahead of the curve a little bit and just be consistent with these 25s, and we're not going to be convinced to go for a 0. That's my take. That's my distillation of this, and I actually think it's the right thing for them to do. I do think they need to be even more aggressive in this direction, though, but they also don't want to spook markets, because if you have a stock market sell-off, you'll probably self-fulfill more job cuts, and then you're in a recession. But if you don't cut enough, then you could also lead to earnings misses and job cuts and a recession. So they're kind of in a pretty damned if you do, damned if you don't position. But anyway, you know me, I'm a valuation kind of guy. If you like my analysis, make sure to check out the stocks on building or courses on building your wealth over at meetkevin.com. And I'm a real estate guy, so if you like real estate, check out househack.com. We've got some really cool things going on, some exciting news coming, hopefully. Go to househack.com, and we'll talk to y'all soon. Thanks so much. Goodbye. Check out those convertible bond offerings over at househack.com. I think they're a great deal. Biased, yes. Read the PPM. Thanks. Bye. Good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.